Welcome to Week 2, Presentation 3. Today we're going to cover some different business structures and discuss the importance of small business in the United States. A sole proprietorship is owned by a single person or a family. They are not considered separate legal entities from the owner, meaning there is legally no difference between Joe and Joe's Lawn Service. Accounting for the business is separate from the individual. Joe's rent and groceries won't show up on Joe's Lawn Service's income statement or balance sheet, and fertilizer and rakes won't show up on Joe's personal finances. However, all profits from Joe's Lawn Service gets reported on Joe's tax return using a Schedule C, profit or loss from a business, and these profits or losses gets transferred to Joe's personal tax return. Any person earning $400 or more from self-employment needs to report this income to the IRS and pay self-employment tax. Because of the fact that the business is not a separate legal entity from the owner, Joe is responsible for all of the debt incurred by Joe's Lawn Service. Also, if Joe dies, Joe's Lawn Service folds. There are many examples of sole proprietorships. Daycares, automotive repair shops, real estate firms, and martial arts studios are a few examples. Any business can be structured as a sole proprietorship, although there are many considerations when doing this. Funding and liability are a couple of these considerations. These pie charts show some of the characteristics of sole proprietorships. The chart on the left shows the size of sole proprietorships by receipts. 67% of sole proprietorships make under $25,000. However, 10% earned over $100,000 and 1% over $1 million. So there are sole proprietorships that can make a lot of money. The chart on the right shows sole proprietorships by type, with over half being service-oriented. 12% are in the retail industry, 13% in construction. Notice that only 2% are in manufacturing, and this might be because of the high capitalization costs of this industry. Typically, to manufacture a product, it takes some kind of machinery, which constitutes a large expense. A partnership is simply a business owned by two or more individuals. Each partner is responsible for the debt held by the company, and the amount of debt is determined by the percentage share of the partnership. It is up to the partners to determine how much of the partnership each partner owns, and usually this is based on the amount of capital contributed to the partnership. Like sole proprietorships, partners in businesses are treated as separate entities for accounting purposes, but profits and losses from a partnership go on an individual partner's tax returns. A partnership doesn't pay any tax, however, the partners do, just like a sole proprietorship. Limited partnerships allow partners to have limited liability. This liability is limited to the amount of capital they have invested in the partnership. The amount of risk they take depends on how much money they put into the partnership, and thus how much money they can lose if the business fails. There does need to be a general partner that does not have limited liability in the partnership. Limited partnerships are essentially considered investors who do not participate in the management of the partnership. A corporation has been defined as an artificial being, invisible, intangible, and existing only in the contemplation of the law. The corporation can own property, they can sue or be sued, and they can be found civilly or criminally liable in court. They are incorporated in a particular state, however, they don't necessarily have to be headquartered in this particular state. For example, Coca-Cola is headquartered in Atlanta, and it is incorporated in the state of Delaware. Corporations are owned by people or institutions who own shares, also known as shareholders. Corporations are separate legal entities from shareholders, unlike sole proprietorships. Because of the nature of ownership of the corporation, they are considered separate legal entities. Remember, they can be sued, which protects shareholders or owners from being found criminally liable for the actions of the corporation. This is called the corporate veil and provides owners protection from the actions of the company, and is one reason why some companies incorporate. The corporation files its own income tax return, and shareholders don't pay taxes until they receive profits from the corporation in the form of dividends. If the corporation defaults on its debt, shareholders do not have to pay this, and creditors have to go after the corporation. Despite the difference between the legal structure for corporations and sole proprietorships, accounting is essentially the same. These businesses should produce income statements and balance sheets, although for sole proprietorships this is not required, by the Securities and Exchange Commission. Publicly traded companies do have to produce these financial statements. Corporations perform the majority of business activity in the United States, and nearly 7 million corporations filed tax returns in 2012. Compare this to 3.5 million partnerships. Only 15% of all businesses are incorporated, but they do generate the majority of revenue and profits. This is not surprising considering the size of some corporations. Walmart is a publicly traded corporation and generated over $470 billion in revenue last year. Revenue at this level is unlikely at the sole proprietorship level. Not all corporations are large publicly held companies. As a matter of fact, most are closely held or private corporations. Private corporations are those in which half of the stock is held by 5 or less individuals. Stock is not publicly traded and is usually owned by family and friends, sometimes even a single individual. Stockholders are usually officers, directors, and employees. Subchapter S corporations do not pay taxes. They're taxed like a partnership, where shareholders pay the tax for the corporation. However, these corporations may only have 100 total shareholders. About 15,000 corporations are publicly traded on stock exchanges like the New York Stock Exchange and NASDAQ. Companies like Walmart, Coca-Cola, and Apple are publicly traded. Owners of these companies are usually not engaged in the business, although many executives and employees are shareholders. The board of directors and management control the company and are elected by shareholders. Shareholders have control of the company, and the job of the board of directors is to maximize the value of shares for the owners. There are different definitions of small businesses. The Small Business Administration defines a small business as one having less than 500 employees. In 2010, there were nearly 28 million small businesses, and these make up 99.7% of all U.S. employer firms. This means 99.7% of firms that employ people are small businesses. They account for 54% of all U.S. sales and have provided 55% of all jobs. Given these figures, consider the profound impact small businesses have on our economy. Over 600,000 franchised small businesses account for 40% of sales and provide 8 million jobs. They also occupy almost half of all commercial space, and the number of small businesses increased by almost 50% since 1982. Despite big businesses eliminated 4 million jobs, small businesses have added twice as many. Over half of small businesses are home-based businesses. 73% are sole proprietorships, while nearly 20% are corporations. Remember that corporations include not just large publicly traded companies like Walmart and Coca-Cola, but small private corporations that might include only a single shareholder. Remember Joe's Lawn Service? Joe might have decided that he wanted to incorporate in order to protect himself from liability. Therefore, he becomes the sole owner and shareholder of Joe's Lawn Service. He now owns a corporation, but is still considered a small business. This chart from the Small Business Administration shows how small employer firms are structured. 16% are sole proprietorships, 11% are partnerships, 44% are S corporations, and 22% are C corporations. Again, these are small businesses regardless of the legal structure they utilize. If you look at non-employer firms, the vast majority are sole proprietorships. That means that a single person owns and runs the entire company and utilizes no employees. Corporations are 7% of these non-employers, and Joe's Lawn Service would be included here if he were incorporated. You've had a look at several different business structures and the impact of small business on the U.S. economy. If you happen to be an entrepreneur starting your own business, it's important that you properly structure your business to maximize your profit and mitigate any risk. You should also be aware of the huge impact of small businesses that they have on the U.S. economy as well. I thank you for joining me today.